environment today, we could see shorter, sharper cycles, potentially boom, bust. And we're already seeing it in markets is just the concern over inflation uncertainty. And for us as fixed income managers, we need to be thinking about our key sources of return and how we use them to deliver high, dependable income for our clients. And here we're talking about three sources of return: credit risk, how we look to rotate in the global opportunity set, accessing credit risk premium. Are we owning Australian credit or global credit? Are we owning high quality bonds versus low quality bonds? In terms of interest rate risk, is ensuring that we can increase our exposure to rates or adding duration in our portfolios when yields are high, or reducing that duration risk or interest rate risk in our portfolios when we're not seeing any value and there is a real risk of capital loss. And lastly, inflation risk. And this is very important in today's new regime, is we want to be owning inflation protection within our portfolios, because there is that risk that today and within this new economy that inflation is structurally higher. And the way in which we think about combining those key sources of return to capture these opportunities and to limit the downside has never been so important. If we think about three different environments, June 2020, the peak of the COVID crisis, we saw governments shutting down economies, central banks taking cash rates to zero. We saw a huge restoring of credit risk premium. So credit markets looked extremely cheap, especially low quality credit. This is where we were accessing credit risk premium and moving to our maximum allocation of credit within our asset allocation ranges. It was an environment where interest rates and bond yields, nominal yields and real yields, were very low. So we did not want to be owning too much interest rate risk or too much inflation risk. We fast forward to April 2022. This was when inflation was really accelerating. Central banks were aggressively hiking interest rates, and we wanted to preserve capital. Cash was the winner. Cash was king, and this is where we increased our cash allocations over above 30% for both our fixed income portfolios. And we didn't want to be owning credit risk. As credit risk, there was the risk that credit spreads continued to widen and interest rates were moving up. So it was certainly a period we wanted to preserve capital and increase cash. And lastly, in today's environment, that economic resilience and inflation uncertainty, we're seeing more balanced portfolio construction, where we're seeing pockets of value within credit, preferring high quality over low quality. And inflation is where we still want to be owning some protection within our portfolios. And interest rate risk, we've seen a huge restoring of valuations within fixed income. So we want to be accessing more interest rate risk on the possibility that growth slows and central banks need to be easing aggressively.